Hi, I'm Fook with Alpha B Group, and today we're going to talk about backdoor Roth IRA conversions. This is another way to contribute to a Roth IRA if your income is too high. Something to note with a Roth IRA is that there's no immediate tax benefit. Instead, the tax benefit comes over long term, meaning that when the account grows over time, all the earnings inside that account is never going to be taxable. So you put the money in now, there's no tax benefit, but inside that account, as it grows, it earns dividends, interest, or capital gains. None of that will be taxable when you take the money out upon retirement. A quick reminder, click that like button. It lets me know that I'm doing a great job and also motivates me to make more videos. One thing to know about retirement accounts is that these are separate accounts owned by each individual person. So even though you are filing joint tax return, a married couple can't own one retirement account. Instead, an individual person owns a retirement account. So one spouse owns it, and then another spouse owns their own retirement account. Because retirement accounts are owned by individual people, for a married couple, it's possible that one spouse will qualify for a backdoor Roth IRA and the other spouse won't qualify. I'm going to explain a few things regarding the backdoor Roth IRA, what it is, who qualifies, and how you should do it. The first thing I want to explain is that there are actually three ways to contribute to a Roth IRA. The first way is rollover to a Roth IRA from another retirement account. You could contribute directly to a Roth IRA, or you could do a backdoor Roth IRA conversion. The problem with the first two is that with the rollover to a Roth IRA, it can be a taxable event. So what you would do is that if you have a traditional IRA or 401k, you could roll that over into a Roth IRA, but that's going to be a taxable event, so be careful about that. The second one is that you could contribute directly into a Roth IRA. The problem with this is that there are income limitations. So if your income is too high, the IRS won't allow you to put into a Roth IRA directly. And if you do, knowing that your income is too high, there is going to be a severe penalty every year if you leave that money in there. And the third way is the backdoor Roth IRA conversion. That's what we want to get into. For the backdoor Roth IRA conversion, we have to make sure that you meet two qualifiers. The first one is that your income has to be over the threshold to qualify directly into the Roth IRA. So pretty much if your income is too high, then we could qualify for it. The second thing is that we have to make sure you do not have any particular IRAs open with funds in it. And I'll explain that in more details as well. The first thing I want to tackle is if your income is too high. So looking at this chart by the IRS, this is for tax year 2021. So if you're watching this in a later year like 2022, 2023, just look up what the new threshold is because this number changes every year. So for example, the first one, if you make under $125,000 and you're filing as single, you could contribute $6,000, no problem. So if you're under $125,000, then you don't even need to do this backdoor Roth IRA. You could contribute to a Roth IRA directly. However, once your income goes above that amount, we're gonna have to figure out, okay, what can you qualify for? So most likely for the people who are watching this video is because your income is over the threshold. We are at $140,000 if you're single, or if you're married, it's $208,000 for 2021. So if you're above this, this is where you are not allowed to contribute to a Roth IRA directly. So this is why we have to do this loophole where we just do, they call it the backdoor Roth IRA conversion. The second thing is that we cannot have any specific IRAs open with funds in it, meaning that if you have a traditional IRA, a rollover IRA, a SEP IRA, or a simple IRA, and there are funds in it, we cannot do this backdoor Roth IRA because what's going to happen is that when you try to do conversion, it's going to be taxable, and we want to try to avoid that. It kind of defeats the whole purpose for that, right? So what we can have though, we could still have traditional 401k, Roth 401k, a 403b, you could have an existing Roth IRA, and you could have a solo 401k. So let's assume that you don't have any of these, or you have zero money in any of these. Like all you have is a traditional 401k. If you have that, then we can go through to the next step on how to set up the backdoor Roth IRA conversion. So if you do have any of these accounts with funds in it, we could still do a backdoor Roth IRA. It's going to take a little bit of work to do it and some jumping through some hoops, but definitely still possible. And I'm going to explain that later on in the video. So for the people who do not have any of these accounts with funds in it, and you qualify for the backdoor Roth IRA because maybe the only thing you have is a traditional 401k and maybe an existing Roth 401k, I'm going to go through the steps on what you should be doing next on how to do this backdoor Roth IRA. Pause. I just realized that while I was editing this video that I didn't talk about why the IRS allows this. So as we discussed before, when you put into a regular Roth IRA, there is some income limitation where you have to be under a certain amount to qualify to put into a Roth IRA. So for the backdoor Roth IRA, what's allowed is that if your income is too high, the IRS will allow you to put into a traditional IRA because there's no income limitation with a traditional IRA. All it has to be is a non-deductible contributions, meaning that you're getting no immediate tax benefit through the traditional IRA. So the IRS will allow you to put into a traditional IRA, and then the way to get around this is where the loophole comes in, is that the IRS also allows you to convert or roll over the traditional IRA contribution, as long as it's non-deductible, to a Roth IRA. So that's kind of like the indirect way of contributing to a Roth IRA because your income is too high. Unpause. The first step is you're going to open up a traditional IRA account if you don't have one already. You could open one up with any brokerage account like a Fidelity, E-Trade, Charles Schwab. You're going to contribute $6,000 into the traditional IRA first. And when you contribute the $6,000 to the traditional IRA, they're going to ask you what year do you want to have it applied to. So you select the year that you want the traditional IRA to be applied to, and then just wait for it to fully process because it could take a couple days for the funds to settle inside the traditional IRA account. As you're waiting for the funds to settle, you could open a new Roth IRA account. It's going to have a zero balance. All you're doing is just going to open it up in the same brokerage that you have the traditional IRA with. And when you open it and the funds are settled in traditional IRA, what you're going to do is you're going to roll the money from the traditional IRA to the Roth IRA. Okay, remember, from traditional IRA to the Roth IRA. So the $6,000 you put into the traditional IRA will now go into the Roth IRA account as a rollover or a conversion. So they're going to ask if you want to have taxes withheld. Because this should not be a taxable event, you're going to say no to having taxes withheld. And they don't always ask. Some brokerage will ask. So if they do ask, just say no. No taxes withheld. And then when you do the transfer from the traditional IRA to the Roth IRA, you're going to make sure that once everything settles inside the Roth IRA and so everything's been converted, that the traditional IRA has a zero balance. It's possible that the traditional IRA might still have a small balance because there might be some earnings that wasn't transferred over, but it should be around $0 when you have everything settled with the Roth IRA conversion. And then after you do that, you just wait again till next year and you do it again. Now, for the people who already have existing IRAs with funds in it, this is what we need to do to try to get around and qualify for the backdoor Roth IRA. So if you have funds in here, like let's just say you have some money in the traditional IRA and a rollover IRA, there are 3 different ways on what we could do to try to get around this to qualify for the backdoor Roth IRA. Now remember, it could take some work, but it might be worth doing all of this just a one time. And then next year you can qualify for the backdoor Roth IRA without any issue. So the first one is that you could roll over or convert any of these accounts over to your existing Roth IRA accounts. Now the problem with this is that it's going to be all taxable. So I wouldn't recommend this at all. It probably wouldn't even be worth it to pay all this taxes up front. Unless you have a small balance, then it might be worth it. So say you put $4,000 years ago into a traditional IRA and that's all you had, then it might be worth just converting it over, pay the taxes on it, just to allow you to be able to do this backdoor Roth IRA conversion every single year. However, if there's like $400,000 in maybe a rollover IRA account, it probably wouldn't be worth converting $400,000 worth of income just to be able to qualify for a $6,000 contribution next year. So make sure that if you do a rollover, you understand that it's taxable. I wouldn't recommend it. The next thing I would recommend, however, is that if you could do something called a roll-in. So if you have funds in any of these accounts, what you could do is roll it in to a traditional 401k at your current company. And by rolling it in from this account over to a traditional 401k, it's not taxable as long as it's considered a roll-in, or maybe even another term might be a rollover into your current company's 401k. And not all companies allow it, but definitely ask your 401k administrator if they allow for a roll-in. A lot of my clients that I've talked to, it's been no problem, and they were able to do this. If the company does not allow you to do a roll in, there is another way to do it. Now, this is where it gets complicated. What you have to do is open a solo 401k and do a roll in from these accounts, one of these accounts, over to a solo 401k. Now, to qualify for a solo 401k means that you have to be self-employed. And if you do not have a side business or anything like that, you just work as a regular W-2 employee, then this is going to be a little bit more difficult because it requires you to open up a business. You have to get a business license, set up a business bank account, and go through the hassle of starting the business. You don't necessarily have to make money. You just have to be open for business and try to make money. But what you can do is just open for business for 1 year, open up the solo 401k, roll everything over to the solo 401k, and that will empty out these accounts right here. And then by leaving the money in here, you'll qualify for the backdoor Roth IRA conversion. However, keep in mind that opening a solo 401k has extra fees for opening up this account. And also there are some reportings that you have to do with the IRS every year to keep this account on board. So there are some options for people who already have these accounts open. It's just a little complicated, and definitely want to run through the process of what you could do to move these funds over into either a traditional 401k through your current employer or through a solo 401k if that's really necessary. And that's a backdoor Roth IRA conversion. Please share, like, and subscribe to this channel. It lets me know that we're doing a good job. Other than that, I'm off to my next video.